Welcome to the deep dive. Today, we're tackling a really big one. CVS Health Corporation.
Huge, yeah. It touches so many parts of American healthcare.
Absolutely. It's like way more than just the drugstore on the corner, right? It's this massive, vertically integrated company involved in insurance, pharmacy benefits, even doctor visits.
That's right. And our goal today, really leaning on the Compascope research report and their latest Q2 2025 earnings data, is to try and make sense of it all.
Cut through the complexity.
Exactly. We want you to come away with a clear picture of their main business lines, the competition they're up against, especially companies like UnitedHealth Group,
Right.
the big risks they face trying to make all these pieces work together, and what this huge $20 billion strategic investment is all about.
Yeah. And with healthcare being so volatile right now, this feels pretty timely. So here's how we've structured it. First, the business itself, those four main pillars. Then we'll look at how they stack up competitively, their strategy for growth, the execution risks involved.
Which are significant.
Definitely. Then we'll hit the recent Q2 results and finally boil it down to the key things you should keep an eye on. Ready to jump in?
Let's do it.
Okay, so the basic structure. You mentioned four big groups. What are these core pillars that make up CVS Health?
Well, the structure really shows their whole strategy, trying to connect everything. Pillar one is the health services group.
Right.
This is where you find Caremark, their giant pharmacy benefit manager, the PBM. They handle drug costs, negotiations, all that. But crucially, this segment now also includes their big move into actual care delivery.
Ah, right, like the clinics.
Sort of, but even bigger picture. It includes Signify Health, which does in-home health assessments, and the really key acquisition, Oak Street Health.
Oak Street. Okay. What's their focus?
They run value-based primary care clinics. Think specialized care, mainly for Medicare patients, often with complex health needs. They get paid based on keeping people healthy, not just for visits.
Got it. So health services is the PBM and the new care delivery arm. What's pillar two, the one we see most often?
That's the retail pharmacy and consumer wellness part. The 9,000 plus stores everyone knows, selling prescriptions, shampoos, snacks.
Front end, yeah.
Right. But the strategy here is shifting. They're really pushing to make these stores community health centers. More than just picking up pills, think vaccinations, managing chronic conditions, basically an entry point to the whole CVS system.
Okay, makes sense. And pillar three ties on the money side, Aetna.
Exactly. The healthcare benefits group. That's Aetna. Insurance. Their main game is Medicare Advantage, MA, big time. Also Medicaid and commercial plans. Interestingly, they're actually getting out of the individual exchange plans.
Focusing their bets, it sounds like.
Seems that way. Probably less profitable, more complex maybe.
And the last piece, corporate.
Yeah, corporate and other. Mostly tech infrastructure, data analytics, the stuff that's supposed to tie it all together behind the scenes. But the main takeaway, the defining thing about CVS, it's that vertical integration attempt. Owning the insurance, the PPM, and the place you get care.
Okay, so that vertical integration, it sounds powerful on paper. Control the premium, the drug cost, the doctor visit. You'd think they'd have total control over cost and the patient experience. What are their actual advantages from this scale?
Well, they definitely have some major levers. First, the PPM scale with Caremark. Just being that big gives them enormous bargaining power on drug prices.
That's huge discounts, yeah.
Second, the retail footprint. Like you said, 9,000 locations.
Yeah.
That physical presence is hard to beat for accessibility. Nobody else quite has that reach for potential health hubs.
True.
And third, the vertical integration itself. If they can make it work smoothly, aligning Aetna with Caremark and the clinics should lead to cost savings and better coordination.
Okay, if it works. But let's push on that. That PBM scale. You see Congress, states, everyone's scrutinizing PBMs right now over rebates and pricing transparency. Is that massive scale actually turning into like a regulatory target?
Oh, the liability. That's a central problem highlighted in the Compascope report, absolutely. The regulatory risks are substantial. The whole PBM model, especially how rebates work, is really under the microscope. That limits how flexible they can be with pricing. And at the same time, they're dealing with operational execution risk. Simply put, stitching together these massive companies, Aetna, Oak Street, Signify is proving harder and slower than maybe they expected.
All right. And how do they look next to the competition? The report mentions UnitedHealth Group, UNH.
Yeah, that comparison is key. CVS has incredible breadth, insurance, PBM, retail, clinics. But the UNH model, Pairing United Healthcare insurance with their Optum Health Services arm, well, the sources describe it as more advanced and refined.
Why is that? More refined how?
It seems to boil down to synergy. Yeah. Optum is really good at generating revenue within the system. Things like data analytics, running clinics, providing tech services areas that aren't attracting the same level of intense public scrutiny as PBM rebates.
Okay. So Optum has found ways to make money that are less controversial.
Sort of. It seems their integration is just smoother, more efficient financially. CVS has all the pieces, but they haven't quite achieved that seamless operational flow like UNH. This makes them potentially more vulnerable, especially against focused players like Elevance, who are really strong in specific areas like Medicaid and MA.
Okay, so if integration is tough and regulations are tricky, their strategy must be laser focused on finally getting those synergies right and navigating those headwinds. What's the plan?
It really comes down to unlocking the value from those big buys, Oak Street and Signify, and finding new ways to make money that maybe aren't so tied to the old PBM model.
Makes sense.
The biggest push is primary care expansion. They're going all in on Oak Street Health and value-based care. Remember, that means getting paid for patient outcomes, not just the number of visits, primarily focused on those Medicare patients.
And Signify fits in there too.
Yeah, Signify helps with identifying patient needs, population health management, often through those in-home assessments. It feeds into the value-based model.
Okay, so build out primary care. How does the retail piece fit into that growth plan?
That's the retail modernization part, transforming those thousands of stores into real community health hubs. It's about more than convenience. It's about making them active parts of managing health, connecting people to Oak Street or Aetna services.
So trying to make the physical stores more integrated.
Exactly. Then on the Aetna side, there's a huge multi-year effort underway, MA margin recovery. They basically have to fix issues from the past where they maybe underpriced plans or underestimated how much care people would need.
So that means what? Raising prices, cutting costs.
Both, likely. Aggressive cost containment, careful repricing of those Medicare Advantage plans. It's a big lift.
And the PBM, Caremark, are they just holding steady or changing too?
They have to adapt. That's where PBM innovation comes in. They're rolling out things like CVS CostVantage.
CostVantage, what's the idea there?
Yeah, it's a new pricing model. The goal is to make reimbursement clearer, tying it more directly to the actual cost of the drug plus a defined fee. It's their answer to the demands for more transparency, trying to stabilize relationships, especially with pharmacies.
Okay, so trying to get ahead of the regulatory curve a bit.
Perhaps. But the big risk across this whole strategy is dependency. Everything is linked. If Oak Street struggles, it hits the MA plan performance. If the PBM faces new regulations, it affects the whole system. And they're doing all this while carrying a lot of debt from the acquisitions. Integration is complex and the financial stakes are high.
Let's zero in on that execution risk. The Compascope report specifically flags CVS as having a higher risk profile than peers. Why is their setup inherently riskier right now?
It really stems from the sheer scale and complexity of what they've bitten off recently. The integration complexity is just immense.
Trying to mash together Aetna, Signify, Oak Street.
Exactly. These are very different businesses, different cultures, different systems. Making them work together smoothly is a massive undertaking, and frankly, it seems to be taking longer and proving more challenging than maybe management first thought.
And you can see that strain showing up financially, right? Especially with Oak Street.
Absolutely. That's the healthcare delivery performance issue. Specifically, they're wrestling with higher than expected medical benefit ratios, MBR, at Oak Street Health.
Okay, MBR. Remind us what that means.
Sure. MBR is basically the percentage of the insurance premium money that gets spent on actual medical care. A high MBR means your costs for delivering care are high relative to the premiums you're bringing in. Higher than expected means costs are running hotter than planned.
So for Oak Street, it means caring for those complex Medicare patients is costing more than they anticipated.
Precisely. And that's a huge problem if your whole strategy relies on that value-based primary care model being efficient. If it's not cost-effective yet, it undermines the entire vertical integration logic.
That's a major operational red flag.
It is. And layered on top of that, you have the ongoing struggle with Aetna MA mispricing. They acknowledge they got the pricing or utilization wrong on some Medicare Advantage plans, and fixing that isn't quick. It's expected to take multiple years of careful repricing and cost control.
So you put it all together, the tricky integration, the pressure on Oak Street's costs, the long fix needed for Aetna MA.
Yeah, the conclusion is pretty clear. CVS's sheer breadth, the complexity of making it all work, and these specific operational challenges mean their overall execution risk is just higher right now compared to, say, UNH, which seems more integrated, or a more focused specialist like Elevance.
Okay, so given all that risk, how did they actually do recently? The Q2 earnings came out in early August, and they actually raised their guidance for the full year. That feels like a bit of a paradox.
It does, doesn't it? But that's where the diversification helps them. Even if one part is struggling, another might be doing okay. The headline was positive. Adjusted earnings per share for Q2 was $1.81. And yeah, they bumped up the full year 2025 adjusted EPS guidance to between $6.30 and $6.40.
So on the surface, things look better.
On the surface. But you really have to dig into the details, especially in the Aetna segment, the healthcare benefits group. Their operating income looked great, up almost 40%.
Okay, that sounds strong.
But a lot of that came from, let's call them, accounting adjustments. They got a $300 million favorable risk adjustment related to old 2024 individual exchange business. Basically, unexpected money coming in from last year's claims.
Okay, so a one-time boost from old business?
Largely, yes. And almost in the same breath, they had to book a huge $470 million premium deficiency reserve. PDR.
Whoa, okay, PDR, what's that signal?
A PDR is basically the company admitting, oops, we underpriced these current contracts and we expect future claims on them to be $470 million higher than the premiums we've set aside. This was specifically for their group Medicare Advantage business.
So they got a windfall from old plans, but had to immediately earmark even more money because they know they're losing money on current major MA contracts.
That's the push and pull, exactly. It shows how complex managing MA is right now. Headline profit looks okay because of the adjustment, but that PDR signals the underlying MA pricing problem is real, significant, and ongoing. It confirms that multi-year recovery challenge we talked about.
Okay, that PDR is telling. What about the PBM side, Caremark? Still holding up despite the regulatory heat?
Yeah, PBM strength seems to be a key stabilizing factor. They reported a strong start to the 2026 selling season. They expect contract retention in the high 90s, which is really good.
Why are they retaining so well, do you think?
They seem to be effective at managing costs for clients, even with expensive new drugs. They specifically mentioned GLP-1s, the popular weight loss drugs. They got 95% adoption for the ones on their preferred list, which shows they can negotiate and steer usage effectively, helping clients control those costs.
Got it. Now, back to that pressure point. Health services, Oak Street and Signify, how did that segment look in Q2? Still the main area of concern financially. The operating income for health services actually declined, and the report was clear. That drop was entirely driven by the high MBR at Oak Street Health.
Even though they're growing patients.
Right. Patient growth was strong, up 31% year over year. So they're getting people in the door at Oak Street, but they haven't cracked the code yet on managing the medical costs for that specific high-needs population efficiently. Stabilizing that MBR is critical.
Okay. And the original business, the retail stores.
Retail resilience was a positive story. Pharmacy script growth was solid at 6.5%, and they gained market share, reaching 27.8%. Some of that came from market disruptions, like picking up scripts from Rite Aid.
Right.
And importantly, that move to the new CVS CostVantage pricing model for commercial pharmacy clients seems to be on schedule. They're planning to shift government business to cost-based pricing in 2026, too. So they're moving forward with that PBM innovation.
And all this complexity, all these moving parts,
Yeah.
it leads to that huge spending commitment, doesn't it? It does. That $20 billion commitment over the next decade for technology and transformation. It's not just about updating computers. It sounds like they're trying to use tech and data to finally simplify things like bundling prior authorizations for cancer care, really trying to unlock those elusive vertical integration benefits.
Okay, that's a lot to track. If you're trying to understand if CVS Health is actually succeeding from here on out, what are the absolute must-watch factors? The 2 or 3 things that really need to go right?
Based on everything, I'd say it boils down to 4 critical areas.
Core, okay.
First, acquisition performance. You absolutely have to watch the medical benefit ratios, MBR, at Oak Street Health. Can they get those costs under control? Can they successfully manage care for those high-risk patients? If the MBR doesn't stabilize, that whole primary care strategy is in jeopardy.
Right. Critical number 1, Oak Street MBR. What's next?
Second, Aetna MA recovery. Keep a close eye on their progress in fixing those Medicare Advantage margins. It's a multi-year plan. A key point will be 2026, when about half of those problematic Group MA contracts are up for renewal or repricing. That's a major test.
Okay, so MA margin improvement, especially around 2026 renewals.
Third, PBM adaptation. How well does Caremark navigate the ongoing regulatory pressure? Can they keep winning and retaining big contracts? And critically, does the rollout of new models like CostVantage actually work smoothly and satisfy clients and regulators?
PBM resilience and innovation. Got it. And the last one.
Finally, deleveraging. They took on a lot of debt to buy Aetna, Signify, and Oak Street. Watching their ability to consistently pay down that debt is crucial. They need to reduce leverage to maintain financial flexibility for the future, whether that's for more investment or weathering downturns. Hashtag outro.
So when you pull it all together, the story of CVS Health seems to be this constant tension, right? You have this incredible scale, this diversification that provides a certain stability.
Right, the revenue keeps coming in.
But it's constantly fighting against these really deep operational challenges, integrating these huge complex companies, managing costs and new care models, and dealing with pretty intense regulatory scrutiny.
Exactly. And that $20 billion tech investment really frames the whole thing. It leads to the big provocative question for you, the listener, to think about.
Okay, let's hear it.
Will harnessing technology and data over the next 10 years finally allow CVS to achieve that seamless vertical integration they've been chasing? Will they unlock the full power of that scale? Or will these persistent operational headaches, stabilizing Oak Street's costs, fixing the MA margins, continue to drag them down, sort of diluting the benefits and keeping them stuck in this complex operational and financial balancing act?
Realizing the potential versus getting bogged down by the execution. That's definitely something to chew on. This was incredibly helpful in unpacking a very complex company. Thanks for walking us through it.
My pleasure. It's a fascinating one to watch.
It certainly is. And thank you for joining us for this deep dive. We'll catch you next time. This content is produced by Compasscope.com. For more than 1,100 public listed companies, find detailed research reports, visual mind maps, earnings call analysis, and audio discussions on Compasscope.com.